What is up, y'all? Let's turn 40K into 400K. What do you think about that? Like the idea of transforming a duplex into $400,000 of equity in 12 months with literally 40K out of pocket just to get into the whole situation. Pretty good deal. And it was all tax-free too, right? But to start this session, I have a very big announcement. I'm regretful. And you know what? I need to, you guys are going to hate me. I always do this. I think I need to adjust this camera just a little bit. I got to admit that it's gonna be coffee today. I don't have a whiskey in front of me right now. I don't feel like drinking at 9 a.m. So I hope it's the same. It looks like you guys are still showing me love anyways. So let's see what we can do with this. Now, I've got a couple notes for you. I was gonna post them in a story, but they're pretty like Elliot's shorthand, right? This is a pretty straightforward deal. There's luck on both ends, but the luck is something that we encounter very regularly and we generate it, right? I don't know what these what's in it for you comments are. I get paid to have this Instagram page. What do you think? I'm probably make about $500,000 a year for having this Instagram page. So there's nothing in it for me right here. You're getting this for free, but yeah, if I make money, what do you expect, man? I'm a real estate investor. So the story of this deal is amazing. And by the way, thank you for showing up at 9 a.m. It's usually a noon thing. I like doing it at noon. I got an old dog, dude. He's a 12-year-old husky, and he had this like floppy tumor on his elbow last year. Got it cut off right before COVID, and then it came back, so I gotta go make an appointment to get it chopped off again. So he doesn't care. He's fine, but you get to see me at 9 a.m., which is a rare treat because I'm a little bit less in weekend mode this early, so you get to see me like real clear and like kind of ready for work and all that stuff, and not waiting on lunch. I love lucky deals. Preface this. We have a business that is built around finding lucky real estate deals. That is our affinity. I think it's the foundation for any real estate investing business is to have a really strong acquisitions engine. Obviously, if you're just a passive investor, you don't need to build a real estate investment business per se, right? I mean, treat your portfolio like a business, but it may not be worth your while to build an acquisitions engine. But everything here nucleates from 2 points. It's our acquisitions engine, marketing heavily directly to sellers in an effective way, and we have networks of relationships with realtors and wholesalers and all that to find these deals at a substantial discount from market value so that we could sell them, make money, keep them, make money, just fucking make money. Obviously that's the goal, right? I mean, what are we here for, right? This is not a philanthropic service, even though we're good to our tenants. We're here to make some cash. So we have an acquisitions engine, and obviously you see this social media page. This is our investor relations engine, right? It's our public brand. It's our recognition in the space, and it drives investors to our platform to buy our properties. Maybe one day we'll partner with them down the road, right? But for now, they just buy our properties, and they like our properties. They're looking for them. They're good deals. So this property, to give you a quick overview, this whole situation, this turned 40K into 400K thing. A year ago, last July, we bought a duplex for $32,000. Lucky deal, I'll tell you all about it, right? It was actually in pretty good shape. So we invested like $4,500 into it. And then we ended up finding a 5-plex for $350 a month and a half ago that is worth $550 all day. And it's in like perfect condition. It's beautiful. We literally bought it. The seller got it in 2014, which was like the bottom in Indiana. The bottom was a little bit later, right? It recovered later. California started recovering earlier. Texas started recovering earlier. So we replaced that duplex via 1031 exchange with a 5-plex that we got for $350 that the seller bought for $310 at the bottom, put $40 into, brand new roof, and repaved the parking lot and cleaned up one of the units, and then sold it to us for like her all in. I don't know why. I wasn't gonna say no. So she sold it to us for what she was in the property for. It's worth $550. So instant equity on both of those deals, lucky deals. Ended up walking away with a net of about $400 between equity, bonus depreciation that translated to direct tax savings. So I used the tax savings, not the deduction amount, and the cash flow that we made on the duplex over the course of the year. And we'll go over all of this stuff in gory detail. So step one is finding the deal. So how did we find this lucky duplex in July of 2020 that we closed on kind of in the middle of COVID for $32,500? Well, we've been marketing to this seller as long as we've been in this business. So since like the beginning of 2017, we've been sending mailers to this particular seller of this 2-story top-bottom duplex. Looks like it was a converted house, but a lot of them were at some point. Nice property, turns out, but we didn't know anything about it, right? So mailer, and if I have a sample mailer, let me grab one for you guys, and I can show you what we send out. I might not have one. I thought it was under, oh, there we go. I shouldn't be showing you guys these, but for the people that show up to the lives and watch these IGTVs over the weekend, they get the secret sauce, so they get to see our mailers. We send these nice trifold mailers here. It's like thick parchment paper. The ink is like really high quality. It's print, right? It's not trying to fool people that it's real handwriting, but it looks like high quality blue ink that stands out, and then like, you know, any letterheads are printed in black so the ink contrasts. It gets mailed directly like this. So it just opens right up. There's no envelope, right? So it's an unusual letter and it stands out for that reason. And the letter has a very personal message written on it. I write every single message for every campaign every month. We get these things all, not these trifolds, but we get postcards and letters from people all the time. And it says, "Hi, John. Call me about your property on this. I close cash. I close fast. I buy as is. I buy in any condition. I buy everything. I'm a fucking sleazebag wholesaler that has no idea how to fucking do this business, and my letter sounds just like everybody else's." That's what you usually get. Now, ours is way more personal. We literally just had a meeting with our sales team about our business's value to our seller and how to maintain its consistency from the marketing piece through the entire sales process through the escrow. That's how much we think about why these sellers would want to work with us and how we could be a better buyer for them so that we convert at a higher rate, so that we win deals. And guess what? We win deals all the time. We get sellers calling us, leaving voicemails all the time that say, "Hey, you know what? I get tons of these letters. I never call them back. But I called you guys back because the letter was nice, because it's something you said, because I don't know why. For some reason, I felt like you were more trustworthy, like you were a more real business." So the message, and then like just the kind of experience of feeling our letter, and consistency. We send these things every 3 weeks to 20,000 people. It's expensive. It's expensive. We spend somewhere along the lines of like $14,000 a month on mail, but it makes us way more than $14,000 a month. So it's all good, but the consistency of sending a mail piece over an extended period of time is extremely, extremely important. Why? Because unlike a cold call or a follow-up, just a general sales effort, these type of letters, "I'm sorry, bro, I'm gonna lock those properties up as high as I want." I got someone saying, "Stop locking up properties for higher than what I can offer." I'm out competing you. Dog eat dog, man. I'm the big dog. So in these markets, when you send these letters, it's going to be really important that you send them consistently, because they're different than like a call. They sit on somebody's desk. They sit on somebody's kitchen counter for a long time. So even though they're not interacting with you personally, right? It's just a written letter. Not that a text message is any better. It's in front of them. It has a longer, it's more persistent, right? It has a permanence about it and a tangibility about it. So it matters to send a bunch of these things. Over years and years, people will call you. And these people called us in 2018. You're gonna laugh at this. I'm gonna take the camera off of, I got a lot of wholesalers mad in here because I'm taking all their deals because I've got better business than them. I'm gonna take it off me and show you my computer screen. This seller called us for this lucky deal duplex in East Chicago for the first time in 2018, August of 2018. Look at this shit. This is their first inbound call to us. You want to see the Salesforce activity log that it took to get them to finally sign a contract? There's the activity log. It's still fucking going. How many follow-ups is that? Can you guys tell me how many follow-ups you see? I see at least 80 follow-up calls. 80 follow-up calls to close a deal. The deal was a deal from the beginning. The sellers wanted $35,000 to start. It was a deal right out of the gates. And let me just adjust my camera a little bit. It was a deal right out of the gates. That's Salesforce, by the way, that we use for our follow-up and just our database management, right? That seller got called 80 times for 2 years. 2 years before they finally signed the contract. Why? Because it wasn't that urgent. They didn't really care about selling. They didn't really trust us yet. Their situation with the property was particularly difficult. It was not that easy to close that deal up. And the luckiest deals are always a little bit more difficult, it seems, because they don't just pick up a letter and call anybody and just take the first call and just sell it to you. Those are hard to get. You got to get really, really lucky to get those ones, because you're no different than anybody else. The ones that are luckiest for us are the ones where we have an opportunity to be different, to be better. And we execute upon that opportunity and we eventually win. And that was very much this deal. So the seller, we tried to get into contract with him in the beginning of 2020. we were not able to get into the property. Why? Because the seller was actually the daughter of the previous owner. Previous owner's name, you won't believe this shit. Dick Slamkowski. Couldn't make it up if I tried. It's on the county records. I showed you guys in the post earlier this week. Mr. Richard Slamkowski was the it's like a total male porn star name, if I've ever heard of one. The seller had passed it on to his daughter. Daughter lived in California. Daughter and her husband, so she had a different last name, right? Owen and Linda wanted to sell the property. They had not seen it in years. They don't go to Indiana. They lived in California, in Southern California, and they were like van lifers. They were in their RV on a journey. They were like out of service constantly. We were on the phone. So it was really hard to reach them, even though they wanted to sell to us. So we tried to get it locked in early 2020 in January. And then we spent like a month trying to schedule an inspection, or a month and a half, and it never ended up happening, right? So it was really, really hard to, yeah, Dick Slamkowski. It was really, really hard to get into this property, even though we wanted to do the deal and we were ready. So we pursued them all the way through COVID. Then during COVID, obviously, like, sellers didn't want to let us in or coordinate anything with us, so we kind of slowed down for a few months. We finally got a fresh contract out to him for $35,000 in like June, as you can see from the activity log of 2020. And we just needed a quick walkthrough, right? So we called the inspector. We're like, don't even do a fucking inspection. Just do a walkthrough. We're gonna buy it ourselves. Go in there, take pictures, tell us what's up with the property. He went in, took pictures. We thought it was gonna be fucked up because the seller had like very little understanding of their property. They didn't know what the rents were for each of the units, which was kind of scary. So we were really riding on value, and we didn't think it was a steal at 35. We just thought it was a pretty good deal at 35 at the time. But once we get in there, we're like, oh, this thing has a new roof. It's got new siding. Oh, it's got dual pane windows all throughout. And then the cosmetics of the unit, not so bad. The nice thing, original hardwood on both floors, and we had no idea what the rents were still, but we did find that the property only had one furnace instead of two, so we had to pay the heat bill on the property. So all utilities included, makes the deal cash flow a little bit more tightly. The furnace was really old. It's still running. It's not a problem, but cash flow was tighter because we had to pay that utilities expense. So we figured, you know what? That's a surprise. Let's go bust this seller back. And we still don't know what the rents are, by the way. We still have no idea what the rents are. So we bust the seller back. We tried to get them for 30. They didn't take it. So we got them. We're like, fuck it, 2,500 off. Lock it in at 325. Close it up. We closed it up in July of last year. Our property manager goes in, finds out that this is what the tenants are paying. Lower tenant, 2-bedroom unit. Lady's been there for like 25 years. She's paying $600, and she's paying all the utilities for the building on her meter as well. And then upper tenant paying $300. Well, guess what? Upper tenant decided to leave. We didn't even ask them for a rent increase. They just immediately decided to leave. They probably figured their rent was going up a little bit because they're paying so little. $300 with their utilities being paid by the other tenant is ridiculous. So they bounced. That unit wasn't in excellent shape. We did some work to it. Went to the lower tenant, said, hey, look, we're gonna take on that utilities bill because legally you cannot make the tenant pay for utilities that are not allocated to their unit, right? Or for somebody else's utilities if you can't measure them out. There isn't like a RUB system for buildings like that out there. But even if there is, you have to take the bill into your name. So we put the utilities bill in our name, increased the rents to $650, put her on a 1-year lease just to lock her in. We didn't want any COVID difficulty or nothing like that. Then we go into that upper unit. The upper unit's weird. This thing was clearly a house at some point, like many duplexes in these areas are, that was converted into a 2-unit. Registered as legal with the city and all that, 2-family dwelling on the county records. But it had a staircase going up and it looked like the tenant downstairs had a good relationship with the old upstairs tenant. So there was a staircase going up that had a door at the very end of the staircase that entered this unit. And it was basically like a common area plus a bedroom and then like a living room that was shaped like another bedroom. But before you entered that door leading into all that, there was another door on the left that took you into a bathroom. So it's like the common area led to the upstairs tenant's bathroom and the upstairs tenant's like living space and bedrooms separately. It was odd. And there was like ducts in the hallway that were for the upstairs unit. So like you're bleeding like really wastefully, right? Bleeding heat into this common area that's like not well insulated and just, space that nobody uses, right? So we had to go in there, we had to build up a new wall, frame up a wall, which didn't cost much. Earlier on, along the staircase, right, or before the staircase, that allowed the tenant to go up and have their own separation. We opened up that bathroom for them. We did have to remodel the bathroom and put new LVP flooring in there, kept the tub, kept the plumbing, put in a new vanity, and just painted the whole place, and a new tub surround. The rest of the unit needed LVP flooring in the common area, but in the bedrooms under the carpet, there was original hardwood. So we just pulled up the carpet and just refinished the original hardwood, two-tone painted it. We put in about $4,200, I want to say, into that whole unit turn. And we got it rented out. It was a weird unit because it was like a one bedroom, but the living room was really a big bedroom also. So we called it a large one bedroom, but it was really like an optional two bedroom for someone with just a very, very small living space in that little common space between the two rooms, right? We got $750 for it, utilities included. So this thing was bringing in $1,400 a month with like $120 utilities bill every month. We were all into it for $36,500 or $37,000. 26% cap rate, screaming deal, steal of a deal. And we didn't plan to sell it until we ran into another good deal. And by the way, I know we were only into it for $32,500 plus the repairs, but we did a cost segregation study. We went crazy on cost segregation studies. If you guys aren't familiar, so if you're a real estate professional, if you're full-time in real estate, a realtor, an investor, a developer, an appraiser, whatever it might be, you qualify for the IRS real estate professional designation, which means that any losses on your rental property that exceed the rental property's income, they could be transferred over to your ordinary income. So you can write off rental property losses against your regular income with no limit because they're not considered passive losses anymore. They're active losses because you're active in the real estate space. So this property didn't have any losses, right? But when you can write off passive losses against your active income, you can depreciate the property at a faster rate to force more losses. I don't want to get into the technicality of bonus depreciation, but basically getting a cost segregation study, which I got online through a site called KBKG for $400. Getting a cost segregation study allows you to take a look at all the different pieces and parts of your property and determine their lifespans and what portion of the property's purchase price they contributed to, what portion of its basis, right, its value that you paid for it. And then you can write off anything with a 20-year lifespan or shorter per the IRS's definitions immediately using bonus depreciation. Long and short is, instead of writing off the property's value at like 3.6% per year, you can write off like 30% in the first year and then just slowly the rest over the remaining years of ownership, right? So we got to get a $7,000 write-off on this property, or $7,000 or $8,000 write-off on this property for buying it, another $4,000 for the rehab. That saved us about $5,500, $6,000 in taxes. Just for buying the property in the first place. It's called KBKG is the website for online cost segregation studies. So we took a fat write-off. We made about $9,000 in net cash flow the first year. We would probably make more in the second year, and the rents did get increased right before we sold it too. We raised the rents $100 on the downstairs tenant and $25 more on the upstairs. No vacancy, just keep the tenants, right? They're behaving, they want to stay in the place. It's been real good. But we probably could have cash flowed more, but in the first year of property ownership, especially with a property that was like really left neglected for a long period of time, little surprises come up. And in fact, when we went to sell it, we even found out, we're closing today on the sale. We even found out that the garage roof needed to be replaced. We replaced it for the buyer. It cost us $3,000, and we took 2 trees out for $1,200 too along the side of the garage. They were like right up against the wall that we just kind of like didn't bother with when we first got it because it was so cheap. We took a look and we just wanted to stabilize it. Right, so we tied up the loose ends. We ended up being into this thing for about $40,000 or so, because $36,500 plus about another like $4,000, a little over $40,000, before we 1031 and exchanged to the next property. So the property ended up being all in for $40,000, sold for $125,000, which is beautiful. Buyer paid the closing costs as our buyers do, and they get a property that's been professionally stabilized by us. So that's deal number 1, but the magic is really in deal number 2. This is where it gets kind of crazy. We found a 5-plex for $350. Direct mail, seller calls us. She just is kind of tired of managing the business. She recently moved from Indiana to Florida to retire and just chill. She obviously had some money, so she got a nice place in Florida. And she just wanted a professional seller that wasn't going to hassle her about the situation, that she could trust. She didn't want to work with a realtor. She had good relationships with her tenants, and she didn't want to jeopardize those relationships with her tenants by putting it on the open market and scaring them and getting them to think that like any random buyer could come and get it and then just kick them out or raise the rents or whatever it is. So she sold it to us for $350. We were going to sell it to our buyers for $440 and make a 90 spot. That was going to make the property a 7 cap at $440. That's about as tight as we can go before it gets difficult to get a loan for 80% LTV for our buyers. But we looked at comps in the area and we're like, fuck, man, this thing's worth 550 all day. All day. It's in a nice neighborhood, Valparaiso, Indiana. True B class, if not B plus area on this fiveplex. It's a 6,000 square foot, big old fiveplex. And at our price, it was only a 9.5 cap. We usually buy 20 caps, right? But the value was so deep that we just had to buy it. We already knew we were buying it before we decided we were gonna sell the first duplex, actually. And we were gonna buy it with a loan. And when I talked to the lender, and she's like, hey, by the way, 25% down is probably what we could do for you. It's gonna be about $85,000 down, or $87,000 down, something like that. Or 82.5. I thought about this Hemlock duplex and went, you know what? It's gonna be hard for me to get a loan on this tiny duplex with these local banks. They're not gonna like me if I keep getting loans on just one-off little duplexes. So let me sell this and just 1031 this sucker. And what do you know? The exact equity in the property was about $85,000, the same as the down payment on the new property. So I'm like, this is an even trade. So I could trade this $40,000 initial investment into a property with $200,000 of equity that I'm gonna owe $250 on, essentially, right? And it's worth $550 or $267 or something is what I'll owe on that thing. So property number 2, $200K in equity. Property number 1, $85K in equity. That's $285,000 in equity plus $9,000 in cash flow plus $7,000 or $5,000 in tax savings on the first duplex from the cost seg and the improvements. And the second property, this is the beautiful part. You buy it with a loan. I spent no money out of my pocket to buy this property. I'm immediately going to get a cost segregation study on this $350,000 fiveplex. And the bonus depreciation on it will probably chalk up to about 25 to 30% of the purchase price. So call it $100,000 in bonus depreciation. It's going to save me right off the bat like $52,000 off my tax bill. Right off the bat on that deal. Not to mention the 1031 exchange. That saved me about $20,000 in capital gains tax on the original duplex there. Instead of having to sell it traditionally and pay long-term capital gains, 1031, no long-term capital gains, transfer into property number 2. And property number 2 is renting right now for $1,000 a unit, $5,000 a month. And my mortgage payment on it is gonna be about, what is it on a $250 commercial loan? My commercial loan for $452 on my Kentucky property is what? $2,200 a month, $2,200 a month, $22, $23, something like that. So on this $250,000 loan, same interest rate, it's going to be like a $1,200 mortgage payment. Tenants pay all the utilities, true B-class neighborhood, brand new roof, brand new HVAC, brand new parking lot, repaved parking lot, cosmetically nice inside, 1980s construction, just really nice area. Yeah, the property's not going to have much expenses at all, just the water bill, probably. So probably going to pocket about $2,500 a month on that deal. Debt at only half of market value, even lower, like really, really under leveraged, right? It's worth $550, debt for like $267.5, so a little bit under 50% LTV. Bank loves it. Just a home run freaking deal. And the point of this is to illustrate that, one, lucky deals make a big difference when you're looking to really roll equity forward, because it's equity that allows you to like hyper grow your real estate portfolio. But two is, there's a lot of little pieces of the strategy that all add up. It's not about just the cash flow. It's not about just the debt payoff. It's not about just the equity, and it's not about just the tax write-offs or the 1031 into the bigger property. It's about being able to use all of these different pieces in an integrated fashion to be able to make the most favorable situation happen. Because, I mean, it didn't take much for me to take a $40,000 initial investment, and with very little effort over the course of the year, there wasn't a lot of thought that went into this thing, right? It was just kind of autopilot, turned it into $400,000 of total value without really paying taxes on any of that $400,000. The only money I paid taxes on was the $9,000 of rental profits that we made on that original property. That's the only thing that added to my taxable income. Everything else, silent, off the books money. Completely off the books, legally off the books. IRS will never see it. If you looked at my income, you wouldn't think I even made that $400,000. It wouldn't show on paper. You'd think I made less than I really did. And that is the key with this deal, is it just went straight to my net worth. Like 391 of that 400 went straight to the net worth. That's it. And that's the point of this whole game, is to add to your net worth at an aggressive pace every year. Imagine doing this with, this is the crazy part, I'll finish it with this. Imagine doing this with a deal every month, with one deal every single month. We didn't buy a lot of property until summer, fall of last year. In fact, we didn't really buy any rentals. We were focusing on making revenue for our business and building our reserves, right? We started aggressively buying property. We've picked up like 60 doors, almost all of them all cash, a lot of smaller ones at lucky deal prices, deep discounts, 30, 40, 50K for properties that are worth 120, 130, 140, right? We picked up a threeplex in December for 50,500. We put in, it was a duplex. We found a third unit in the basement the seller didn't tell us about because he was owner occupying both of them. Picked up 50,500, put on a window. One window, $400 in the basement, and now it's renting for $2,200 a month or something like that. It's worth $185. In December, we'll 1031 that thing too, and we own it all cash. So we're going to take $185 and put it towards $800,000 of property. It's probably worth about 1.1 or 1.2. So that 50 really turned into something along the lines of, I don't know, 600, 700, right? Especially once you include the bonus depreciation on the properties, probably about 700,000 worth of value. Do it every month. Do it every month. Really start racking up that portfolio and start doing this more consistently. You're probably not gonna be able to do it at the pace that I do because the rate of lucky deals that I get is unrealistic for many who aren't in this business full time. But if you could do it once a year, or get to the point where after 5 years of accumulating, then you're doing it with 1 or 2 properties a year, then you can skyrocket your net worth very, very rapidly with the right strategy, right? So the goal for us is gonna be to 1031 probably like $1.5 million worth of equity over the course of the next 5 years into $6 million more worth of property that's going to have some deep equity position. And it's not long before your net worth starts growing by $5, $6, $7 million a year if you play the game right. So that's my message for you guys. It was a really cool deal, really cool story, a lot of little things going on. So hopefully I was clear enough. Second cup of coffee, so I'm a little caffeinated, so I probably should have talked a little slower as usual. But I'm ready for questions. Hit me with tax questions, hit me with finding deal questions. I mean, I talked about a lot of shit over the course of this live, right? So anything that pertains to this story, this sequence of events, give me what you got. I could do my best to kind of help you like land in the same situations. So I'd usually take a break to drink my whiskey at this point in time while we're waiting for the questions to pop in. But I don't have whiskey. I just got some coffee today. Jason, you should have bought that deal, man. Should have bought that deal. You didn't like the bathroom wall. That's the cool thing about the properties that we own for a year. We love, since we're just starting to buy properties, right? We haven't got a chance to do this too much, but we love the opportunity to be able to buy properties and sell them to our investors after we've owned them for a year. We get the deal at a really lucky price, so we don't mind spending a little more money and dealing with headaches and not making a lot of cash flow in year one, right? Because they're usually a little bit distressed. But we clean it all up, professional management, property stable, and then we sell it at fair value to our investors who get a property from us that they know the story about. It's already under professional management from the company that they would choose, and all the little bullshit's been handled, or most of it, and at least they know what hasn't been too. So it's like the most predictable situation. I think a big part of our property sales, if you're one of our investors on here, is gonna start moving towards you guys getting properties out of our portfolio that we're just growing out of. Houses, duplexes, fourplexes. Hell, you know what? That Kentucky property that we got for $475, that's worth $900 now, we could sell it in November and just take the $450 of equity and move it into something bigger maybe. So you might see that nice 12plex come down the line pretty soon here. How do I prep for these lives? This is just off the cuff. So I just took like 5 minutes to write down some notes on this story because I remember this transaction like pretty intimately, right? And all the details of it. Then there wasn't a lot of preparation on this. If it's a more technical live, like I talked about banking, I'll usually take about half an hour or 20 minutes to write down an outline of the process that I want to go through to make sure I describe things in a more coherent fashion. Today I wasn't super coherent, at least I'm the judge of myself, right? I'm pretty hard on myself. But if it's an educational topic that's like a lot of theory, then I'll definitely spend like 20, 30 minutes writing a page worth of detailed notes, giving you a nice order of things. And then I'll take a picture of the notes and share it with you too. But I like speaking. I'm not afraid of the camera at all. So I kind of have fun with these and I just say what I say. And if I fuck it up, I fuck it up, whatever. I'll be back next week, right? Looks like you guys are still here. Did I start buying properties with my name, then transfer them to the LLC? No, bought them in LLC from the beginning. LLCs are easy to form. I'm not really that worried about the different tax implications. the way I see like things like LLC formation for real estate investors and commercial lending is they may add complication now, but like my goal is not to like slowly grow into it. My goal is like hyper growth. Like I'm trying to be like the person that's been doing this all their life within like 1 or 2 years, right? So anything that I know that I'm gonna have to do eventually, I just jump straight to it. Straight to it. Give me the commercial loans right now, form the LLCs right now, get the attorneys to get everything dialed in right now, and as long as it's not too time consuming and gets in the way of like the entrepreneurial momentum that we need as a small business, then I'm like, hey, don't try to skimp out and save on like that little bit of complexity or extra cost if it's something we're gonna have to do anyways. Put the system in place, behave like we're bigger than we really are, and then just when you grow into it, you never have to like remodel and reshape your business structure when you really, really need to, when you don't have the time, and when you have a bigger business that's gonna require more effort to do it, right? How do you start with a 40K? You know, my business did not start with 40K. This business started with $800 from me, maybe 1,000, and $1,000 from Mike. That's about it. And it took, we sent our first mailers out in February or March of 2017. Our very first direct mail. It was a very different market then, right? So you're not just gonna get that lucky with direct mail like we did. We picked a market that had not yet recovered yet from the crash. Everything's recovered now. But we were going after I think we got lucky with our market selection. It was lightning in a bottle. Like Hammond, Indiana at the time is where we were at. And Hammond now is way too hot. Like we have a hard time making deals happen in Hammond most of the time. But back then it was like not even starting. It was barely starting to take off. So we sent postcards, just the big ones, because no one sent the big ones. Everyone sent the little shitty little ones, right? And then we wrote annoyingly personal messages to like grab people's attention. We almost trolled them, right? But $400 total per month from like February through like August, right? So maybe it was a little bit more than 1,000 each. It might have been 1,200 each or something like that. By August, in the month of August, we made $40,000 in wholesale assignment fees. We made 25 the month before, so it wasn't a bad month either, right? But we had like doubled our personal incomes. We were working jobs. We both had 6-figure jobs and they were demanding. We worked full time, right? Maybe Mike's was like a little bit more flexible because he was self-employed. But I was like a 9-10 hour a day sales rep for like a software company, right? It was work for sure. That $1,200 each very, very quickly catapulted into millions of dollars, very quickly. So you do not need this whole myth of you need thousands or hundreds of thousands of dollars or mommy money or daddy money or some fucking angel investor or some bullshit like that to be able to start a business is completely unrealistic. Usually that amount of money gives people the comfort to go and take a really small risk, which is funny that it takes that much comfort to take such a small risk. But yeah, this whole business, I mean, we'd replaced our income within like 5 months with a $200 a month each contribution and about 2 hours a day of effort. Now it was well built and the product was well selected, which I would say for you guys is choose the right business model if you want to get rolling. Choose the right market, choose the right type of rental property, choose the right type of monetization scheme. Do it well, and you won't need a lot of money or a lot of time to be able to make it skyrocket, right? But you gotta be good at business. And that's a learned ability, by the way. Do I only identify and send mail to properties that are visibly distressed? I do not buy distressed properties most of the time. They're usually by mistake. They're usually completely by mistake. They come to us, but we do not target them. We target stable quality buildings, and we're just looking for some equity as it is. Because look, with a distressed property, you're looking for equity. With a stable property, you're looking for equity. People are willing to sell their properties at some amount below market value with all types of products, but for a variety of reasons. And you have to understand those reasons and make sure those reasons align with your business's monetization scheme. For us, selling stable properties to buyers that want quality is probably like our benchmark, right? Trying to find that stable property. The hard part is getting people that are not distressed to call you, but if you could do that with the right message, then you're tapping into a product that is desirable. So no distress. I don't look for people that are back on their taxes or any of that shit. If they come to me, fine, but I prefer not to chase after people like that. I want a good property. Do you engage consultants or anything to help establish your operating model? Never paid a consultant once. Not at all. Literally just like, got to work some jobs that really taught me like how to operate a business in a variety of ways. I worked in biotech for years on the process development side. It was highly technical. I was in supply chain for like a very large organization, right? Like a $50 billion company. So I got to see like the intersection of like science plus like volume of production, and understand how like to build a process that allows a business to be extremely efficient and lightweight, and still produce like a consistent result and convert at a high rate. And then I got to work in sales for a while, and I applied like that process mentality to sales. So I got to really build sales processes, right? And that's really what applied to this business. Didn't need consultants. It doesn't take that, guys. I think a lot of people just don't go and try shit, and they don't go study other businesses enough. Study other businesses and the unique things they've done to be competitive, and you'll find that you can like steal a lot of ideas from different industries that no one in your industry is applying. Like, don't think that just because everyone else is trying to do it, whether it's wholesaling, flipping, multifamily, real estate investing, whatever kind of business you want, don't think that because it's saturated and there are other people trying to do it left and right, that means that each one of those people knows all of these tricks from these other spaces and is implementing them. There's a lot of stuff that is just being left alone. So go and find ideas from different spaces and apply them to yours, and it'll make a big difference. You will become competitive by nature. We don't even know who our fucking competition is. We don't know they exist. We don't even think about them. Let's see. A buddy is doing a 1031 in New York State. What should you look for to get assistance? I don't know what you mean by assistance. A 1031 intermediary, right? You're gonna need one of those, but you can just reach out to a variety of title companies and someone will have it on staff. I mean, it's not a hard thing to find, and I don't think the service level is kind of important, I guess, because you want them to act in a timely fashion, but that's about it. I think the hardest part of the 1031, anytime, but particularly these days, is finding a replacement property, right? Because you've got a 45-day identification period to write down your candidates for replacement properties and be able to provide them to that intermediary company so they can submit it, right, for to the government, basically, the IRS or whatever, wherever they have to submit it. I don't know exactly. Once you create that list, you can't buy anything outside of that list. So you've only got 45 days to identify potential candidates, and you have 6 months to close on one or enough of them, right? And you can't just buff that list with 100 different properties too. They give you a limit on value that you can allocate on that list. So that's the hardest part, is being able to acquire within a reasonable period of time to meet those replacement guidelines, the identification period guidelines on 1031. Any idea what software you might use for making OMs for multifamily properties? I don't know what OMs are, operational models. That's probably what I'm guessing. Are you looking to model out on the acquisition side? Are you looking to model out like on the operations side, like once you actually own the property and just like for the sake of tracking? I'm not gonna be the pro here. I know a lot of people like on the management side will probably use like in-house software for bigger multifamily. For smaller stuff, I think Buildium is technical enough. Appfolio is a little bit more bare bones. But on the acquisitions end, I'd say, build an in-house model or find someone that can help you build that. I don't really chase IRR, right? Because the properties I'm looking for are not like these big upside projects, and my model doesn't pull investors in too. Like any upside project that like factors in equity over time into the rate of return is gonna be something I take down with my own money, probably even buy cash. So I'm not really worried about that. I just see the equity in the deal and I see the tax strategy behind it for my business, and I just kind of pull the trigger. So I'm definitely not your guy for that. You might want to talk to maybe someone who's like an analyst for like a commercial real estate firm who works on the acquisition side, and they can help you build a good model on the acquisition side. And there's a lot of people like that too. They're like, relatively new to the space. They just specialize in this, right? Like I've met people that are 24, 25 that or commercial real estate analysts that could probably help you with that. It's just their niche, and it's just not mine. And why is it not my niche? This is something that we talk about all the time. These smaller properties are under the radar. I can make a lot of money on these smaller properties just because I'm not competing with like private equity, but I get to come in here with a little bit more sophistication than the traditional investor in acquiring them. I'm not mad about picking up, every month a duplex, which I really do. Every month, a duplex for 30 grand that's going to be worth 125 in a year with $7,000-8,000 I have to invest in it over time. And I'm picking them up more frequently than that. We just picked up a 10-pack of houses for 30 grand a pop that are worth 80 each. Walked right into them. Maybe some of them are worth probably 60, but they range between 60 to 80. One of them is worth like 85, or even close to 90. So yeah, under the radar. It's kind of nice. I don't want to fucking compete with big money. Screw that, man. I don't have cash like them, and I'm not as smart as those guys, and I'm not trying to work as hard as them either. So just know where you can find your advantages. What do I think about Ohio, Cincy? Hard to find a deal in the good areas. In the rough areas, the turnover is pretty tight. Overall, the landlord-tenant laws kind of scare me, and the tax rate's pretty high too. So there's like a bunch of different things kind of squeezing that market for me, and that state in general too. Like the market that I like fundamentally is Columbus, but it's just overpriced as all hell. without any justification. It's just California money, seeing a place that has growth, so they just overinvest in it. Cleveland has a lot of turnover in the working class neighborhoods, especially in like multifamily, like small multifamily, so I don't really love affordable housing in Cleveland. I have not been able to really make it work in Ohio. I mean, I'm sure you could find cheap stuff there for sure, but yeah, I don't like the fundamentals of it. And it's not close enough to Chicago for me to say it's piggybacking on the trend of a Chicago exodus. So that's all. That's what I think about it. But if I had to pick a market in Ohio for viability purposes, I'd probably pick Cincy. So I think you're on the right track. What do I think of Las Vegas and Henderson? It's just too expensive, man. It's too expensive. There's no value there. It's cheaper than California, so people look at it and go, wow, this must be a good deal. And it's growing, right? But everyone knows it's growing, so they're paying for tomorrow's growth. And that's the thing, is like, you don't want to buy like an investment, a stock even, just because you know they're the future, because oftentimes if everyone knows they're the future, they're paying future price for them. And it's not worth its future price. It's overvalued, right, at that price. So it becomes speculative. I would say focus on properties in a market that have the growth fundamentals in place, but also a floor for yield, right? Like the same way people say, I don't want to buy a cash flow property if I don't see some population increase or a certain rate of rent growth or a certain rate of wage growth. Cool, you have those boxes, right? Those growth boxes that you need to check as bare minimums before you'll invest in a cash flow property. Why not have the converse for a growth property, right? Hey, I won't buy a growth property unless it meets this level of cash flow. These landlord tenant laws have those like minimum prerequisites on the other side of the strategy as well, and I think you'll be in a healthier place to like risk adjust your portfolio. I don't want to buy a property that's like a 5 cap unless it's in a 3 cap market, and I know I've got so much equity in it, right? I'd rather buy something that like has at least, if I were you as an investor right now, with interest rates being as low as like, my clients get like 2.75 from my bank. They get really hooked up. They're usually like 3 to 4 when it comes to commercial investments or commercial loans for like the average consumer, or 3.5 to 4 is what I meant to say. I don't know if I said 3 to 4, but with my clients getting like a 2.75, I'm very hesitant to give them anything that like doesn't have like a 6.5 cap if it's under rented at currents, and then at market rents, if it's in pretty good condition, like a 7.75, 8, right? If it's already pretty close to market rents, I'd say around a 7 is pretty safe. Especially if it's a clean property in a good neighborhood that has good fundamentals for like, value growth and rent growth and all that stuff over time, right? So I think a 7 is around the safe place. Right around a 7 cap is a safe place right now if it's a quality clean property. Now, if it's a property in like the hood that's in shit condition and it's super under rented too and has potential to get to a 7 one day, it's probably not a good investment. But if it's like a 1970s, 1980s build, hell, if it's older and it's in good shape and it's got decent tenants, clean, nice neighborhood, single family homes nearby, or like trending for homeowners and go at a good value, then I think a 7 is pretty safe. That's where I draw the line. Next 6 to 12 months, crash or more inflation. Sean, I don't really think the inflation's that bad right now. I don't think it's as bad as they're making it sound, because there's so much stuff that's like COVID supply chain disruption that's still in place that's causing goods to be more expensive, plus stimulus money in pockets that people are willing to spend, that like inflation becomes highly like incidental, right? Categorized in separate buckets. Like if you go to the store, if you go to Costco, look, this is what I buy, all right? You're gonna laugh, but this is the kind of stuff I spend money on. I go out for a beer last night with my roomie. It's still $5 for a can at this bottle shop that I go to, right? It's still $7 for a pint. It's been $7 for a pint for a little while. Maybe it was $6.75 a little, like 2 years ago, year and a half ago. And I'm not crying about that. I go to Costco and I buy a pack of tri-tips, and now that the summer craze has died off, it's still $6.50 a pound for a tri-tipper, and it'll probably drop at the lowest in the winter to like $5.50 or $5.70 a pound, like it always does, and maybe instead of $5.50 it'll be $5.65 this year, $5.69 or something like that. I don't see that inflation in that spend, but if you're the person that just fucking has to buy a car, a nice car, a boat, and tech stocks, right, or growth assets all the time, then they're going to appear to be inflated, and inflation will be more real to you based on what you spend your money on. So like regardless of whether it's real inflation or not, or whether it's high or whether it's low, or whether it's systematic because of COVID related things, or it's actually organic inflation, it still divides amongst categories and it's indexed to create this average CPI, right? And it depends on how you spend in these categories. Your dollar is only losing purchasing power, not value. Your dollar doesn't lose value. Your dollar loses, your dollar is not worth 80 cents, right? Your dollar loses purchasing power relative to what you're spending on. So if you're spending on things that are going up a lot in value, you're gonna be like, fuck, man, I gotta get this money out of my pocket before I lose it. But if you're like me and you're buying things that are like consistent in value over time, you don't really feel the squeeze. I'm sitting on a lot of cash, dude. So I'd say patience is good right now. I would say don't not invest. I'd say increase your liquidity reserve or your opportunity fund size. When the market's really high, I like to hold a larger opportunity fund. When the market's really low, I like to empty that opportunity fund because there's a lot of good opportunities available, right? So based on the availability of good opportunities, or I'd say my cash reserve that I hold, my desire to keep cash, is inversely proportional to the availability of high quality investment opportunities. Long fucking rant about inflation, but I just think a lot of people oversimplify things. A headline is all it takes to get them thinking. You know, a news story is all it takes to get them thinking, but you don't actually people don't stop and sit and formulate their own conclusions based on the decomposition of trends. So that's all. Yeah, this will be available once the live is over for sure. I'll save this, I'll put it on YouTube, I'll put it on IGTV. I'm starting to put these on YouTube so you guys can actually cast them onto your TV in the background or your iPad or your laptop or whatever it is. And I know YouTube is just a much better video watching platform than Instagram for longer videos. How did I find my CPA? I fired my old CPA. He was a referral. He was good. He liked to kind of gouge on charge a little bit once he saw we were making more money, which is probably normal. I don't know. I mean, who knows? But he definitely did some funny stuff this year about billing for something at much more than the normal hourly rate that I didn't like. It made me question his integrity, so I just moved on to a new CPA who happens to be one of my investor clients. This is not a brag, but this is a realization. The beauty of being in this business of finance and helping people place their money to make more money, and also having this large social media following that has very recently become large, is you have access to a lot of people. So get to meet a lot of cool people through this. CPA is one of them. Happy to work with this new guy. Definitely not referring out, because what am I gonna do? Send him 10,000 people? Right? But referrals are the best way, I would say, to find a good accountant or any professional service. We just got an attorney for some advertising consultation and corporate structure and asset protection, and it came through a referral. My business partner's cousin is an attorney in the Bay Area, and he just kind of looked through his network for us and said, this is your guy. And the guy's all the way in Florida. He's like, this is the guy. So look in your network, ask for referrals. Previous experience from people is going to be key. What do you need to come to my office and pick my brain? Whiskey, coffee? I'm sorry, I can't take either of them. Consultations, just not on the books right now. Mentorship or shadowing, not on the books right now. I think it would be fun to, when I clear up a little bit, have a once a month pick a day where someone maybe from, who buys one of our digital products, right, is entered into a lottery and given the opportunity to come to our office and shadow. I think that'd be really fun. Maybe even video it, right? Bring a video person, have conversations, cut it up, make a YouTube video out of it. That sounds like a lot of fun to me. I don't think I'm ready for it yet. There's a lot going on in the business, but watch for it down the pipeline. I love to teach you, right? If I can. I'm really happy to have the opportunity to even have learned this stuff that I could share with you guys and add value. I really enjoy it, right? I want to pass it forward. I really believe that everyone can do it too, and that's something I'm passionate about, is showing you guys that everyone can do it. So as soon as the opportunity arises, yeah, fucking come meet me. Come hang out at the office. Come watch our sales reps, what they do, see our process. I'm not afraid of you stealing our secrets by any means. I mean, this is an executions business, right? So if you could do it better than me, by fucking all means, go get your bag, player. Florida never disappoints. I don't know, that's sweaty as fuck, and I do not like humidity. How am I structuring my financing and debt with the assets I buy? This property I'm buying now, this 5-plex, is the second property I've ever bought with debt. We've been buying stuff cash left and right because early on our business didn't qualify because it didn't have long enough tax returns or a long enough record of income on our tax returns as being purely self-employed. But we started making money quick. We were fortunate. We made a lot of money quick, so we bought everything cash. And then we just kept selling stuff, right? So we were able to balance out our sell versus buy strategy and our income that we want to project at the end of the year to show on record by buying what we didn't need to sell, so we don't pay taxes on it. Now, when it comes to financing, we always get these deals at lucky prices, right? So when we go to a lender, they won't give us 100% of its true market value or 100% of our purchase price just because the market value is higher. Example is this $550,000 market value fiveplex we're buying for $350. Lender said, I want to give you 75. And you know what? I only want to have like 50% LTV anyways. Math works out that 75% of 350 is almost about 50% of 550, right? I like to under leverage because I'm self-employed. I like to under leverage because I don't like risk. I like to under leverage because I have plenty of cash right now that I do not need debt against because I have cash to spend still. So there's no shortage of funds, so I don't need maximum debt. And I think banks fucking love to hear that. They love to hear that. If you guys were watching my story yesterday, I posted, my banker asked me, and they always do this at these local banks. They ask you to kind of sell yourself at the very end of underwriting. You've already sent them all your financials, and they're like, give us your story. The underwriter wants to see your story. Our sales manager wants to see your story. They want to decide how far they want to take this relationship with you and who you are. Are you reliable? And a big part of that story is your relationship with debt and your relationship with money and income and liquidity. And I'd say showing them that you have a responsible and healthy relationship with money. They don't want to see you have a fat car loan on a Lamborghini, even if you can afford it, right? They're like, this guy likes his Lambo more than he likes paying us, for sure. That thing comes first. But when they see that you don't have any of these like massive obligations and that you live a reasonable life, but you're a high income business owner and you're really passionate about real estate investing in particular, that's your number one priority. And being able to manage your portfolio takes precedence over like all these personal liabilities that you'd like, then they're gonna be more likely to lend to you. So I like 50% LTV maximum, and it works out that way because we get these properties at discounts. How do we make money that quick? A unique business model, a twist on what wholesaling traditionally is, an improvement to what people were getting from turnkey companies. They come to us instead. They find a hybrid approach with a hybrid product, but a very high service level still attached to it. We take good care of our buyers, and that's because our money or our model allows us to make a lot of money. If we're making $100,000 on a deal and a little surprise comes up, here's $5,000 buyer. Just come back. Just be happy. Just come back. We don't care about $5,000. And that's because we don't make 5 and 7 and 10 pops on deals. We won't do a deal or do a business that makes us so little because we want to be able to have room to like keep the quality of product and service as high as possible, right? Is Gary, Indiana is attractive because of prices? Is it safe to invest there despite the high crime rate? Crime rates are kind of deceiving because we found that they don't directly correlate to tenants moving in, paying, and staying, which are the most important things in your property, right? The next most important thing is going to be rent growth too. You want the rents to go up so that your equity in the property doesn't get diluted over time because expenses go up obviously over time, right? If your rents are flat or not increasing at a rapid rate, you don't get any appreciation. The thing about Gary is, there's a high crime rate. There's a lot of shitty neighborhoods, and there's a lot of board ups. And there's a lot of areas that are not boarded up. And there's a lot of properties that are being cleaned up now that previously weren't being bothered with. And that's because a lot of people are moving in for working class jobs. There's a lot of new working class jobs. A Hard Rock casino and hotel opened up in Gary like 6 months ago today. Like a full-on big Hard Rock hotel and casino right in the heart of Gary. Of all of Indiana, they chose the center of Gary. I'm sure they got cheap land. I'm sure it was an opportunity zone, so they got massive tax benefits on the developer side, and a lot of cheap working class labor and a lot of available housing that could be modified and improved for people to live in who are working there. Strategic decision. I'm sure it wasn't a mistake that they chose to develop it there, right? Guess how many jobs it created in Gary, just that one little place? 2,600 jobs. Smartphone manufacturer from Chicago moves over their operations completely to Gary, Indiana. Just within a month after that, 1,600 new jobs, right, on technology manufacturing. A lot of industrial infrastructure is available. Everything's really cheap there. It's almost like a void that is just waiting to be filled if the need arises. And guess what? The need is arising because businesses want out of Chicago, and we're seeing a kind of a resurgence of manufacturing and like certain working class jobs, certain classes of jobs here in the US, and Northwest Indiana is prime because Indiana business law is top tier, right? So what are we seeing in Gary? Let's see, a 3-bedroom townhouse just rented for one of our clients for $1,000. It was listed for $1,000 with our property manager. They would have listed it for $750 a year and a half ago. So what happens when the value of rents goes up by 30%, 35%? The property value is going to trace it, right? And when the quality of the properties improve because the tenant class improves, then the cap rate compresses even further, meaning that people are willing to pay more for your property. So is this a big pitch on Gary? No, go ahead and evaluate for yourself, right? But those surface level statistics are usually the reason investors pass on opportunities that are not bad like they think they are. So being able to go a step further than that is going to really allow you to make a better decision on investing in a particular city. What platform do I use to find hot markets? Just fucking good old fashioned roll your sleeves up and dig in. We got a process. We don't use a website. We use a bunch of different websites. We use a lot of public data. We use our understanding of what makes these places start to turn and work. We use a lot of real people and their feedback in these markets to get an idea of what's happening. We don't really, default to like platforms. And, without offending you, people that you just default to the internet, a website, just an easy research tool, it's a lazy way to make an investment decision. Most investors make the lazy decision. Most consumer investors make the lazy decision. By taking the path less traveled and making the more difficult decision by engaging in a more involved research process, then you have an opportunity to win where the other investors overlooked something. So that's my thought on that. And it's not just thought, it's not even opinion, it's definitely fact there. So hold on to that little bit if you can hold on to any part of this live. I don't know anything about the new Fannie Mae regulations, to be honest with you, because it's just very much consumer homeowner type product. What else we got? What do I think of Temecula? I don't know, I wouldn't stop there. And I'm from Sacramento, and I wouldn't stop at Temecula, if you can imagine that. California is not a good place to invest in real estate right now. That's what I think. I mean, at least in residential rental property. I don't know if people do Airbnbs here and do well, whatever it is. I don't like the laws. The values are really high too. It's a market that like tends to peak high and bottom low and then grow really fast overall, right? I'm not really interested in buying it at the high peak. I'll buy it at the low bottom if it ever happens. If it doesn't, I won't be upset that I left money on the table. I've got other opportunities elsewhere that are more predictable. The more involved process, it requires, like I said, talking to a lot of real people, amongst other things in the area. Do I have clients from overseas? Do they need an LLC? I recommend the LLC. You can form an LLC in the US. It's not difficult to buy from overseas. You just have to buy cash because a lot of lenders here don't want to lend to a borrower that's like in a different country completely, right? So you might be able to find a lender that could like refinance you after, but yeah, as long as a borrower or a client of ours has a United States bank account established with funds already available in it prior to signing a purchase agreement, and they're able to put down a deposit like everyone else, and they're willing to buy cash, yeah, we work with them. It works out pretty well. Not like, debt is highly favorable in a lot of other countries either. I know in Canada it's really cheap though, right? But the cap rates are also really, really, really low. Florida is such a hot market, guys, and that's another one of those like priced forward things. Florida, Atlanta, Texas, and then certain cities like Columbus, Ohio, right? Lots of North Carolina, they're just so trendy right now, even though they're fundamentally strong over an extended period of time, where they may be fundamentally strong over like the next 10, 15, 20 years, right? There's growth prospects that are legitimate. People right now are willing to pay such a premium for those prospects that they become overvalued assets. It's really, really hard to invest in these places. And that's no offense to Florida, but I wouldn't buy a 5 cap. I said it earlier. Your growth properties should have a minimum checkbox for cash flow. That's what I think. Canada interest rates are really, really, really low, and their properties are very expensive. I've seen people get like 1.2% interest on like rental property loans in Canada, but the property's like a 3 cap, right? And it's millions of dollars. So give me one more question and I'll bounce, make it a good one. I'll scroll up a little bit and see if I find a good one. And if not, I'll just go back to the bottom and I'll answer a fresh one. All right. Thoughts on multiplexes near major colleges or universities, such as in cities like Tempe, Arizona. So here are my thoughts. Can I repeat what I said about Temecula? I'm from Sacramento, pretty lame place. And if I were driving past Temecula, I wouldn't stop there. That's all I gotta say. And it's in California, so I wouldn't invest here. I don't invest here in Sacramento either. So college towns. Interesting thought, maybe not a popular line of thought. Towns that rely heavily on a college only tend to behave in a very commoditized fashion. Now, if there's other industry that's like moving, you always want to look at the trajectory of a town, what's happening. Nothing really fucking happens with colleges. It's like military bases. People are like, well, I know that's kind of a shitty city, but there's a military base there, so it must be a good place to invest. And it's like, well, not really. I mean, like, is there going to be sudden massive rent growth because this military base has been there for 50 years? right? Now, if they're expanding the footprint of the military base and moving a lot of people in, if the college is growing and they're accepting new admissions and building and buying more properties around, and if they're just buying more properties around, if they're building too much, also maybe a problem. But if you're seeing like a trajectory with that college, then there might be something going on with the town. But otherwise, it really becomes a niche. So do you want that to be your niche, the student rental? Is that the specialization that you want to have? I'm not saying don't, but it doesn't interest me much because it's not something that I could take and like have a sense of undervaluation attached to without just luck, right? Like in the markets that I'm in, I could say, hey, I can get this property at a discount from its current market value. And then I know that relative to tomorrow's market value, because of what's happening here that I've identified, it's even more discounted. In a college town, it's very, very hard to do that. They're just little bubbles. Right? Same with little like military-based towns that have nothing else going on besides that. They're little bubbles. So they're a little too predictable in behavior, right? Or too consistent in behavior for my taste. I need a little bit of volatility to give you some upside. What's my exact business model in an elevator pitch? I'll make this my last question. We purchase and immediately resell on the same day stable, occupied, well-maintained, high cash flow rental properties in different states in a fashion that makes it very easy for an investor in a completely different state who's never seen the property before to be able to purchase it and generate a reasonable return. That's it. That's my pitch, guys. I gotta go. I got a whole day ahead of us over here. I gotta cram in before I get the dog over to the vet and come back. Thank you for joining me on this live. Sorry I missed last week. I was in Insta jail. So appreciate you sticking with me. I will see you guys next Friday.